Yeah, good evening, guys. Ken at Tortoise Capital. This is the nightly strategy podcast for July 30th, 2021, Friday night. So we will be reviewing the weekend reports, and we had a little pre-workshop chat about Edward R. Murrow and Walter Cronkite and the era in when there was a time people believed the people on TV and had powerful voices outside of the government telling the truth about what they saw, and it had an impact on people's lives. Murrow was legendary for standing up to the tyranny of McCarthy in the anti-communist era, and then Cronkite famously saying the U.S. should get out of Vietnam, that it was an unwinnable war and an unjust war, which was sort of the end of any popular support, if there ever had been, for that war. And you look around today, and there's nobody even close to that kind of magnitude in as being a icon of truth and courage in the media. That's it's hard to believe there was a time when that was not the case, but some folks are old enough to remember that. Well, on we go. So tomorrow we've got some soccer work to do, and so the Foundations Q&A is going to go at 2 p.m. Central, and I'll get that recorded and posted in the usual way. But it's going to go at 2 p.m. Central Time, not 6. And then the Saturday evening swing portfolio review will follow that at 4 p.m. CST, not at 8. So we're accelerating that by 4 hours to take care of business tomorrow. The regular Saturday morning coaching call for the folks that are in the True Story Circle will still go at 8:30 in the usual way, and looking forward to some interesting work in progress reports from the team. So just as an update, I'll post that on Patreon as well. I've been trying to get the times edited at GoToWebinar, but it's not cooperating with me. So I wanted to just post those times for you in here. Okay. Yeah. All right. Let's. So I have been talking about this move here as like a green zone kind of move, a real strong, powerful trend that happened after the channeling signals. If we're looking at the price crossing the dragon like a Kata 2, that signal in the broad market fired right about here. The last Kata 2 was like here, and then it traded to this move. That RLXD allowed us to miss that. Then this triggered all of the channeling and overreaction swings, which then paid off really well. The Kata 2 entry was this one and has been moving up. And I have been describing these daily moves sort of like this. I thought the next 2 days were kind of choppy. Yesterday, Thursday, was a provisional green day because I felt like it had closed strongly, but then we didn't get any follow through today, and yet it held at the edge of the dragon and the edge of the river, where it's still stable. It hasn't gone negative yet. This is just in line with that move. I argued yesterday why I believe the swing, that RL270 line like this would be a powerful indication of upward strength. Now, we didn't get that today. It opened below that. It ran up briefly, but then closed below that. So tentatively weak to me. It did not make that move, and so I did not maintain, the extra swing positions that I was prepared to take. Just didn't get that. I talked also for a moment about the possibility of the RL90 being a similar sort of extension, looks like that. And I talked about the Bollinger, or the Dragon's spine as a potential time series. I still think both of those are possible. And also looked at the southern skin of the dragon as a possible. Those are still time series that are available. The lower skin of the dragon, you might as well be on the PSAR in that sense. But I think both the the RL270 timeline failed. The RL90 is open and in question, and that's really like the skin of the dragon too. So, to me, sitting that close, that's a position I would not hold over the weekend. Anything extra, the regular swing trades I have that are in play have their own stops, but on a market basis, this is not a market that fills you with confidence. It's not one to be negative about yet. It's just right on the cusp of preparing to fail back to the Bollinger Band mean. So that's the least surprising move, is a move that comes back to the Bollinger Band mean. Now, if it went up this fast, it could go down that fast. So we would say something like, in the next 5 days, a return to the Bollinger Band mean would not be abnormal. It would be the least surprising move. And so for me, this is why I would just say, hey, at this point, I just draw that line at 438 and say, you know what, I don't want any extra risk. I'm trying to avoid and manage against this potential downside move here, right? So I don't want any of that. So I think we're right on the edge of a downward trending tactical sell kind of a market down to the Bollinger Band mean, and that would look very much like this kind of a move, where it rolls over and it couldn't hold. You get a crossing of the dragon and it runs down to the Bollinger Band mean, and maybe even as far as the bottom of the river. So the first stage of that is here, and going into the weekend, that's not one that I want to hold at any excess gain. So any swing trade that was still in the money, that had its stop in place, I kept that, but I did not add any new positions today on the basis of what I thought was a failure to follow through kind of a move. Okay, so that's my assessment of where we are. Still bullish, still grinding, but very clear reasons to be cautious here, like there always are. I still kind of like the spine of the dragon being a good time series as like the final protective stop against, I would say, now if we use that as an indicator, I would be like right here. I call that 437. So that's about another quarter of an ATR, or basically a 2-bar low. So if we had any kind of failure on Monday, that stop would trigger. Okay. So that's how I build my tactical view of the broad market. So what I'm trying to do there is get the market call firmly in my mind, and then use that to shape my opinions about sectors and individual companies. So this is a market that is not contributing to the upside very much, and it's poised. It's a coin flip on whether it goes up or down on Monday, even more than usual. And then the failure, let's say at 438, 437, in my view, could very easily trigger that move down here to the Bollinger Band mean, and I don't want to see any of that. So I'm concerned about that sell-off. Okay? If it gets through the Bollinger Band mean at 430, call that 432, now I'm really concerned about the next stage down to the river bottom. That to me is where you pick up a very strong downward bias, because that would have negated all of the favorable price action of the last 20 days um, which would negate all of this, and then that would open us up to moves further down like that, right? So that's why, to me, the first line of defense is this one. I don't take on any extra risk. Where my bias changes to the downside is if the Bollinger Band mean hits. That's like the manager's exit. That's where the routine, rules-based just says get out. Now, what's important to notice on that is that number comes in right near a 2.5% sell-off from the swing high. So that's actually, even the Bollinger Band mean is a pretty aggressive sell-off, a pretty aggressive stop. But because we're trying to fine-tune our swing trading with daily and hourly charts, that Bollinger Band mean is kind of the last ditch for optimism for the upside. So there's still a little buffer, but I am cautiously mindful right now. Okay, let me know if that makes sense. So, let's see. The Ken H asks, where would the stop be for a core position? So the core positions are coming from the monthly rebalancing, the blended monthly rebalancing portfolio. And those have a default position of 10% from the highest high. And so the highest high is 442, so 10% would be $44. So 442 minus $44 gets you down to 400. And so here's the 5% sell-off, right? The 5% sell-off is at 420. So you got to double that down to about 400. Now, in my view, in this market that has been so strong, I'm concerned about that. What I do is, if I've got more than a 5% gain, then I will usually raise that stop to 5% static, and then let the market grow. When it gets to 10%, pick up the swing again. But to me, I don't think you can. I don't think you can hold a core position beyond this price level here, which is geared towards the bottom of the RL10 and the belly of this dragon. To me, that's a 5% sell-off. There's no way I'm giving back more than 5% in this market, even on the core positions. I'll take, if I wanted to maintain that position, if price got down to the 5%, that's where I've got to start adding the market neutral hedge with the swing position, so that I don't have to sell off the core. I would make that market neutral with a hedge until such time as the market voted up or down. But at 5% is where I put the core position hedge on in order to lock in this gain, because that core position over the last 30 days has gone from here as high as here. So I don't want to give back that move. That's why the swing trades are taking their stops. But in the core position, at 5%, I got to make that market neutral, because I don't want to give back more than that. So I would just say the short answer to your question is 5%. That's where I would put that. We'd have to look at the whatever core positions you're holding and kind of do the same analysis. The way I would also look at that is if you go to a weekly, here's a 9 days, sorry. Let me go to the weekly. So if we look at the weekly, what I have been teaching about is that the weekly PSAR is a really compelling stop. Like if we go back and look at this, from all the way back to the COVID sell-off of March 2020. God, does that seem long ago or not? To me, it feels like yesterday. But that powerful move from 240 to 440, that's like a 90% move. And the PSAR weekly, here was a sniper exit and then a sniper reentry over in here, and then you got the two big legs of that move. So to me, the weekly PSAR is a pretty convincing place to have a stop. Well, you could think of that as hybrid core trading, and look where that price is. That price is at 420, and that's the 5% sell-off. So that protects you against a move down to the Bollinger Band mean around 405. The 10% stop would get you down to 400, which is like halfway to the bottom of the river. So to me, the PSAR stop is the compelling one, because that's the one that protects you. Look how that protected you during the time of COVID, and it protected you against what could have been harsh reversals. Now, you don't know that those were going to reverse and go higher. So the weekly PSAR dot, to me, is an improvement over the generic core 10% trailing stop. That's my position on that. Okay. If we looked at the monthly in SPY, 400 is the spine of the dragon. You could make the argument that the edge of the river is a reasonable stop on a monthly basis. That would get you in at 380, and that's too far for me. That's $60 on 480. That's a 12% stop. That's too far. So to me, you have to be like maybe spine of the dragon, or I could even live with the RL30 in this case, and that gets you around 405. I like 420. I just think 420 is a 2-bar low on the monthly, and I could live with that. Don't overthink it. Having just overthought it, I then tell you, hey, yeah, don't overthink it. But that took about 4 minutes. That's how much time you should be worrying about the core positions because of the basic principles of that system. And so a weekly adjustment of your view of the monthly core, that's the next step up from the once a month fire and forget. The core system is really designed for even less work than we just did. And so it's designed to do no harm. So there we are. All right, let's take a look at let me know if you found that helpful in the chat box there. All right, let's find the S&P here. Here we go. SPY. All right, let's take a look at our primary sectors. The big broad indexes. So the S&P started off here. The S&P was down 0.5% today. Diamonds were down 0.38. Treasuries were the only index of the 6 that were in the green today at 0.5. So that closed at 149.52. So it's flirting with 150. And while the market was stalling as we just saw. Treasuries are holding their grounds pretty well. On a weekly basis, notice that kind of stealth trade there on the weekly treasuries. And you will recall, if you go back and listen to what we were saying in around early June, this was that trade that came out of the harsh winter. Winter turns to spring. I mean, if this isn't just the classic template for supported spring crossing, I just don't know what is. What's better than this as an explanation? You have a harsh winter here. Anybody want to argue with me about a harsh winter from 170 to 130, 134 in the treasuries? Bueller? Nobody? Okay. So now we have... now what we have is the RL10 rolling over, crossing the baby dragon, entering the dragon, turning to spring, leaving the dragon, the RL10 never crossing back over the dragon. So an entry here with a stop down here at the bottom of the RL10 never gets hit. If this got you out, then this gets you back in here at about maybe 140-ish with a stop at 134, so that's a $6 risk. And now you're looking at a, from 140 to 150. So that's plus $10 on a $6 risk. We're looking at basically 2R. It had gotten back to the long-term fair value here. It's at the far side of the river. And then a while back, we built these, I think off the daily. We had built those little time series, the time stops. And they're holding pretty well. This green one is pretty good. When we look at the daily, let's see what that was. Yeah, that green one was basically paralleling the RL90, and that still feels pretty good. Maybe it stalls a little bit here. So if we just kind of update that and just say that's like the RL90 extension. And then this one is like this used to be the Bollinger Band mean extension, the manager on the daily, and that's been holding up pretty well. But notice how the Bollinger Band mean has accelerated a little bit. So we got to update that one. That's like the manager exit on the treasuries. So if we just do that, that's where we kind of can project. Now I would take this stop here, the static stop, and I think I would raise that to maybe the 3-bar low and just put that at 148.50 and keep that in play. This one was the treatment of the PSAR, and it's been kind of marking along with that pretty carefully. That's too close. The daily PSAR is not really a swing. Is not really a swing trade. So we'd have. I like where the green and the red ones are in terms of swing trades, and then with a locked-in stop here, call that 3-bar low. And that's like at 148-ish. So when I go back to the weekly, that feels pretty correct, like right here. Now we've moved this up to the 3-bar low, which is the edge of the river. I can live with that. And then pick up the, I'm going to move that out of the way. And then I'm going to pick up the green. I like the green. That one feels good to me. Something like that. All right, that's the treasury play. And if it gets above 150, that's a really strong sign. Now, to the downside, the Qs were down a half. The Russell was down 2/3. Emerging markets was down 1%. So today was a broad-based give back in all of the sectors. So let's see all of the things that underperformed, so that we can just worry about things. Moonshots down a half. Here's marijuana. Blended commodities 0.56. You got lumber. Oops. Lumber, the crypto large cap, finance, Archgenomics. You got Japan. The FANGs got a hit hard with Amazon sell-off. Oil and exploration down 1.2. The other lumber 1.2. Just notice that cut is always much better than wood. So if you're going to play lumber, use cut instead of wood. ARC Innovation 1.3. S&P Biotech 1.4. Mexico Energy. Consumers discretionary 2%. Remember, that was one of the big ones yesterday when we were joyful. That failed. And that has gone into the fall, you'll notice, on the MACD Four Seasons. Agriculture 2.5. Let's see. And then Brazil 5.67. Really disappointing there. The companies that failed, this is dominated by the disruptors. You get Squarespace, PayPal, Virgin Galactic. You also have some of the materials and energy guys like Devon Energy, TX, the steel company, Twitter. Yeah. All right, let's take a look at the upside sectors, or the cause for hope. You got tech was flat, blockchain flat, oil flat, wheat and precious a little gain. Consumer staples, clean energy, Coinbase, materials up 0.3 and 0.4. Simon Property Group, the commercial real estate, up a half. Lithium 0.7. Tesla, nice little gain. It's at 687. It had some grit. VIX, that's some protection being bought for over the weekend. Now the bigger gains of the day. Ethereum 6%. As we get closer to the August fork, when there's going to be some major news about Ethereum being updated and being lower cost per transaction, that's going to start the next narrative of why Ethereum is a standout and stable as a mature crypto. So I'm expecting a run in August for Ethereum. U.S. Steel 4%, Alcoa 2%, Bitcoin, Tesla, Cliff. So most of the metals except TX had strong days. John Deere 0.5%, Apple 0.15. So basically the metals. It was metals and real estate today. The safest play, consumer staples 0.17. So this was a day that there was no follow through and no urgency to buy positions to hold over the weekend. So this has become a very tactical market in later stages of the grinding bull. It's still grinding higher, but the runaway moves are over, and now individual stocks and sectors are making their cases. So what that means is you got to move towards either the longer term grinding, like on the weekly charts, or shorten up your time frame and try to get more out of the 30-minute and hourly charts, because the daily charts are not given the juice today. That's how I read that. Okay. All right, let's take a quick look at the broad markets. Let's see where we at here. Okay, so some good work from the guys today with some crosstalk. Um, Peter did a nice job here on video, and he was using the idea of the market for plan and prepare, and he was using the market to do plan, prepare, execute, and assess. And this is the logic chain that he used to get towards to find NVIDIA as the opportunity. And we're going to notice that that was a gap down morning hook and then two legs up, and we're going to see how he gets along with that. So in his planning and preparation, he noticed that the S&P was up in the morning, the NASDAQ was better, the FANGs were good, and so he was looking to trade things like Microsoft, Apple, and NVIDIA. And so he was stalking trades out of that logic chain where he's looking at. That's how he gets to the large cap tech stocks. And so now Microsoft, Apple, and NVIDIA are the conservative, clear winners in the large cap tech space. These are not the disruptors. These are the ones that are that have won the tech game and are more like value plays in my view. And you can trade them when tech is doing well, but the disruptors are suffering, which is the current condition. Then these old school. It's hard to think of Microsoft, Apple, and NVIDIA as old school, but there they are. That becomes a little target of interest, a little subsector in tech that you can look at. So that's how he gets to large cap tech. And then we're going to take a look specifically at NVIDIA on 2-minute charts in this case. So I really want to acknowledge and respect that effort. Now, the first trade. Now, you notice this is where it closed, and then here's the gap down. Here's the RL10 reversal after price was down at like Z3. You get this consolidation, and here's the bottom of the dragon. And this is where here's where the first opportunity to trade is, like at 192.2. And in the chat, what would we call that opportunity, especially as it's approaching the crossing of the VWAP? What would we call that? Yeah, in the chat, we're calling that supported spring crossing. Yes, that's what we'd call that, supported spring crossing. And I also think of that as the morning hook, the early surprise move to the downside that gathers all the easy stops, buys inventory, and then runs the price up. So here's a move as an example from 192 to 195. So that's $3. And then if you're taking this entry here at 192.2 and your stop is at the bottom of the dragon, it's at 191.8. So that's 40 cents. And if you use the bottom of the RL10, that's 191.4, and that's 80 cents. So you're getting a $3 move on either a 40 cent or an 80 cent risk, which is either 7 or 3 execution R on that first move. The next opportunity is this one where you have like a COTA 2, because now the RL10 disregards this little sell-off and recovery, so it bottoms out here, and now he perfectly plays, well done, perfectly plays the COTA 2. Now he's using a wide stop to the VWAP, which is more than the dragon, and it's more like, it's the VWAP, that's legit. And so that's about from 194.6 to 193.8. So that's 80 cents. So that's twice we've seen 80 cents as a legit buffer between price action and then a signal that says it's over. And you'll notice that the width of this is also about 80 cents in this choppy sideways action. That's the noise level. And so it takes price breakouts from that to get your attention. So an 80 cent buffer here on NVIDIA is about right. Like, you don't need more than 80 cents to tell you that the upward move is over. So he gets his entry at 194.6, 80-cent risk to the VWAP, gets 1, 2, 3, 4, 5 bars. So that's 10 minutes. That gets to 195, or I'm sorry, 196.15. So that's $1.60. So that's $1.60 move on an 80-cent risk. Yes, that's 2R in hand. And so this is the 2R battle drill, isn't it? Yeah, it's a 2R battle drill. And he takes the stop at 195.50, which is about a 1-2-3 exit. And that gives back about 60 cents. So not quite a full R. And I think that's a perfectly played trade. And you get from 194.6 to 195.50. So that's 90 cents. That's about 1.1 gains. So I really like that. And notice how that protects you against an additional move of $1.50. So the 1 unit of that you give up protects you against a sell-off at 2. And then he finds the next, like a 1, 2, 3 entry as it's crossing into another COTA 2. Now that doesn't follow through, and the PSAR flips, and then because of the failure to follow through, scratch, perfectly played, and then that protects you against this sell-off, and then he has the fortitude to stay out of Crocodile River as the sideways quiet channel begins to form around the VWAP. And now he's identified about an 80-cent risk box that makes an interesting play for a breakout in either direction. Like, I would be willing to get long here on a breakout of Z2 at 194.80 with the idea that it's going to go back up and test this again and then might follow through. Or if it fell below 193.8, I'm now thinking it's going to come back to the earlier VWAP, and it's like 192. So in both cases, you got a 2-to-1 trade in either direction from this 80-cent breakout. Now, the trick on this is you could actually buy it on a breakout with half the box as your execution, and now you have a 40-cent risk because you're using the VWAP as the dividing line. It breaks out, you use the VWAP as the dividing line, you have a 40-cent risk, and then this move up here gives you about 3 execution R, and the same thing to the downside. In the hybrid trading course, we called that buying on the button, and here's the next piece. Now, instead of waiting for the move at 194.8, because the move of the day was kind of up, you could buy it right now at 194.2 with a 40-cent risk, which is a stop and reverse short. And now if it does break out, you have an extra 40-cent gain in hand. And you're still only taking a 40-cent risk. Now, when you listen to the bar-by-bar exercises that we listed in the Foundations workshop, you'll see Lisa doing some of that technique called buying. We call that buying on the button. That instead of just waiting for the move, and it feels like it's stabilized at fair value, take your pick. I would pick up because of the previous urge to get higher. So I would just buy this now at 194.25 with a 40-cent risk, which would be a stop and reverse. And then what I'm looking for is that the move that moves back to 195.6 and 196.2, now I'm getting an extra R because I'm buying it in right exactly on the button. That's what we mean by on the button. So that's a very advanced technique. I don't want any Foundations guys doing that, but I want you to know that that's one of the evolutions that we get towards. Okay? So really nice work on that one. Well done, Pete. You did your due diligence. And I don't know if you can trade that any better than what you just did. So well done. All right, this one is, let me think, who put this one in there? Yeah, Nigel. Is Nigel in here tonight? No, Nigel's not in, but he'll hear this over the by tomorrow. He's done a really nice job on this. Man, this is good. And this is how you mark that up for learning. I can see the learning going on. So now you notice what he notices. A harsh sell-off into the winter. Supported spring crossing. It's really an owl. Because now you notice not only has it crossed the RLX, it's done the RLXD and the P1 and all that stuff, but this is all stabilized, and now you actually have the RL30 rolling up and the Dragon rolling up and the PSAR flipped. So he held out for the owl and uses a stop like we're supposed to at the PSAR. Long. He's looking for this move back to the previous VWAP. He gets it. He has a 1-2-3 exit. Ladies and gentlemen, 4R properly. He considered the second position on the basis that this one failed to fail further and resumed. So that's a perfect place to front run the crossing of the VWAP, and then that would have been an additional 3R. He was concentrating on managing one position properly, and you'll notice that that gives you the calm to look for other opportunities that you don't intend to take. That's like noticing things when you're driving. You feel comfortable driving in the lane and at the speed that you're at, and so you can relax a little bit and notice more things about the situation going around behind you. Like, don't rush to get into traffic. Just maintain safe following distance and all that, and you can start noticing more things. That's kind of what this is like. So nailing the 4R is perfect. Resisting the urge to trade inside sideways quiet channel is perfect. Now notice that the R factory is very nicely marked up Z3 pinches. Now there was technically an entry here with a stop at the PSAR, which would have paid off. And then this is also a collapsing dragon. So this is a Z3 pinch breakdown from here. And then this is the collapsing dragon. It wasn't clear for him, and so he didn't take it. He tries the SSC and gets 2 bars in his favor. The third one collapses and he scratches. Good scratch. The best scratch I've seen lately. This was a re-entry opportunity that he notices. That's an owl, because you notice the dragon and the RL30 have rolled up. But he was not in the zero state, so he quite correctly does not take the trade. And now he notices a Kata 2, doesn't take it, and then he stays out of the sideways squat channel. So that's how you do 4R properly in the DAX. Just exactly what I want to see. This one is, let's see, this is Jamie. This is a hybrid frog, perfect, 1-2-3 exit for 2.5. Perfect short on the RLXD and reversal to a 1R win with a 1-2-3 exit on the correct side of the dragon. Good scratch. I mean, when I say that, I mean good 1R loss. This is a reasonable effort. I don't mind this one. Maybe in a 1-2-3. The stop and reverse is the one I want to see. I still like that. I don't mind this at all. That's poised. Like if this collapses, you're going to get that run down to the previous VWAP in a hurry. So I don't think that's an error. I just think that you took the shot. What I like is that you were still in the zero state and could get this reversal. And you picked up 2R here to negate these. And you end up with a 4.5 for the day. Oh, here's another one out here. For another perfect. This is what I'm talking about, like that buying on the button. Like you feel like the urge was up, it failed to fail, and you got this almost like a, it's not quite a Kata 2, but it's buying on the button, and then it works. Instead of waiting for the Z3 pinch breakout, you lock in the R that was available. So that's what I mean. And then this one, if this had failed, you're short if this fails through here, and then that would be a big move down. So just nicely done. Well done, fellas. All right, shifting to the weekend report. That should read the 30th. How did I miss that? Anyway, this is July 30th. God darn it. On your pen and paper, make that July 30th. That should read the 30th. So, normal. Only the 2-day showing weakness. Cautionary in the risk Z. 50% exposure in ETF2. Monthly is chugging along. I've made the argument already for why 420 I think is the right level. The 9-day, nothing weird. The weekly is actually still not bad, and 430 is kind of where that needs to be on the weekly, which is about a 2% protection. The 3-day would like 435, please. Edge of the river. We've talked the daily already. BMR portfolios. The leaders held up pretty well. Some signs of life in mid caps and the Russell. So longer term, I actually have some hope for the next leg up. But I'm liking the move in treasuries for all the reasons I talked about earlier. Materials and energy are showing some strength here. The leaders were reasonably stable this week. ETF 32, commodities and energy making a comeback. Russell, still the real estate IYR still strong. That's one of the core positions. Tech wasn't bad. Finance finally showed a little bit of life this week. But clearly materials are looking good. Materials and energy are starting to make their run. In the Dow, Procter & Gamble and Honeywell. You know I love Honeywell. I have a bias there. Metals and mining showing some strength in here. We saw that across the board in the metals. That's why also the materials are up. Materials include more than the metals, so it was a little bit diluted. Semis, this is what led Peter, I believe, to the play in NVIDIA. So XSD is a way that you can play that directly. And notice that it's been lagging, so there is some room for semis to continue to go. So if we saw tech make a resurgence and semis doing well, XSD is certainly a way to play that for the sector. Let's see. U.S. large caps doing pretty well, relatively. Canada, Mexico, Brazil looking good. Let me let that come up on your screen, sorry. Yeah, so the U.S. large caps doing okay. Canada, Mexico, Brazil doing very well. Otherwise, not much to love other than commodities and oil, and U.S. real estate is just quietly getting it done. New leaders in ETF2. Let me let that come up on your screen. New leaders in the form of tech, IT, growth. That's all the resurgence in tech. But notice real estate is just getting it done, both as the direct real estate, then also the REIT index, which also pays a nice little dividend. The usual traders are still liquid and volatile energy, Brazil and China, regional banks and biotech, and oil exploration. Just like 4.25% average daily volatility. That's very, very tradable intraday. All right, we're going to shift to the daily. We've seen all this before. No channeling and overreactions this close to the 10-day high. Handful of dojis in play. me let that come up on the screen for you. Sorry. All right, so handful of dojis today. Breakouts in Nike and Procter. Nike swing is still working. Still working, Ken H. A couple auto framers of note. We got Amgen as a 5DD. Salesforce 2.3 to 1. IBM and Intel. I kind of think Intel has a chance here. It's been so bad for so long, and it was better than the market today. For the same reason we like NVIDIA, I'm also thinking Intel is quietly setting up. In the ETFs, we got 10 dojis today. One little breakout in materials. Otherwise, not much. I still like this. Look at Treasury. Still, for all the good reasons I've been talking about, and they're still 3.9 to 1. There's a lot of room left in Treasuries, especially if we got some kind of weakness in the broad market based on this COVID phase 3 or whatever this Delta variant is. Our military college went back to 100% mask on inside the building. So the Delta variant is getting everybody's attention. They're probably going to require vaccinations for all the military. It was encouraged but not mandatory. They're making it mandatory, and there's some latent panic reaction baked into the cake here, as the Democrats who now are in charge are sweating bullets about COVID doing to them what it did to Trump. So there's going to be some panic reaction in play. It's going to get dumber before it gets smarter. In the auto framer, we have a handful of goodies. Still looking good. Treasuries in the number one position at 3.9 to 1. I don't know how you don't love that. Framing data is available there for you. For the, for those of you doing the mechanical trades. Let that come up on your screen. Yeah. I kind of like Intel hidden in the middle there at 2.4 to 1. Handful of daily squeezes in the usual way. Not much to see there. Kind of a grinding day today. Nike and Procter & Gamble are the winners in the Dow. And only the materials and treasuries. Notice treasuries becoming that alternate store of value when you see broad weakness everywhere else. When you see broad weakness everywhere else, it's now treasuries are becoming the reasonable alternative. So we like that. And among the losers, actually, XLP, the consumer staples, is the other alternate sector that's acting as kind of a defensive play, store of value, so don't neglect that one. And everything else is kind of business as usual, nothing else to see here. All right, that's everything I got for you. We'll get this published and posted. And remember, tomorrow the Foundations is going to go at 2 p.m. Central, not 6. And the Swing Portfolio Review will go at 4 p.m., not 8. Right? And I'll post a note on that on Patreon. So thank you very much for your kind attention, and we will get back to work. See you tomorrow.